Chief Economist from AMP, Shane Oliver. Shane, I was asking you about your thoughts on the RBA.
Yeah, no great surprises from them. They're really just outlining similar forecasts to what the governor had outlined back in April. But he did also point out, if you look at their scenarios, they had an upside scenario there, which assumed a earlier and quicker easing in the lockdown. And it does appear that the government, and now the New South Wales government, seems to be heading down that path towards a somewhat earlier lockdown than the RBA had assumed in their base case. So that suggests that maybe there's a bit of upside to the Reserve Bank's growth forecasts. I guess, though, there's a lot of water to go under the bridge here, so I won't be changing my forecast anytime soon.
Yeah. Remind us of your forecasts.
Well, they're actually fairly similar to what the RBA came up with. We're looking for a 10% contraction in the economy in the June quarter, probably also a contraction in the March quarter, so that takes us into recession. Probably, I say. March quarter may not necessarily be negative, but then a bit of a rebound in growth as we go through the second half. So for the year as a whole, we reckon GDP will be about 6% lower, then we see a 6% rebound next year. Unemployment on its way to 10%. We'll probably get news on that this Thursday, that we've already hit that 10% level. By the end of the year, though, we're still going to be pretty high, up around 9% by the end of the year. So I think that's the way we see it. We do see a recovery through the second half of the year, but it's going to take us, I reckon, at least 18 months before we get back to the level of economic activity that we saw at the end of 2019.
Well, we can certainly see some people. I noticed the parking meter ladies are back, but in terms
of the traffic jams, I was out there yesterday, and lots of traffic out there again on a Saturday morning.
Well, exactly. But when you think about Australia, there we're often told what an extraordinary service economy we are. People are now talking about a V-shaped recovery. I just wonder how much up the other side of the V we're going to get to when we've got problems with things like tourism, education, airlines, all that sort of thing. They're not going to come back anytime soon, are they?
That's precisely right. We have to accept that in the absence of a vaccine, we're not going to see a return to full international travel. We may be able to go back to New Zealand, or maybe go to some of those so-called first mover countries that the Prime Minister had a meeting with last week. But apart from that, it's going to be very limited. So that's going to limit the number of tourists coming to Australia, and that's going to slow the recovery and slow the rate of growth we get to when the domestic economy has recovered. But it is worth pointing out that the bulk of the reason the economy contracted was because we were told to stay home. We weren't allowed to go shopping and do all the things we normally do. That accounted for that big hit to the economy in the June quarter. The other thing to note, or that we're likely to see in the June quarter, the other thing that we note, that the real hit to Australia, if we don't see a return to international travel, is via education. We actually run a trade deficit on tourism, but we've got a surplus on education. We really need to find a way to get our students coming back to our university.
What are your expectations for what the Treasurer might be talking to on Tuesday, which otherwise would have been budget day, wouldn't it?
It would have been. It's amazing the way this has crept up on us. And, of course, now the budget's not going to be unveiled until October. I think he's really going to say pretty much what he said last week when he had a speech, I think on Tuesday, National Press Club, where he outlined the impact on the economy, which has been horrendous. It's been horrible. What that might mean for economic growth, and also prospects for economic recovery as we gradually start to reopen. I think what will be of most interest is how they see the impact on the budget. I don't think they're going to provide any detailed numbers there, but they might provide some outline. Obviously, they're spending $200 billion. That's a huge amount. That's about 10.5% of GDP. So that's a big spend, but there's also the downside from lost revenue. And so the budget blowout will be a lot higher than $200 billion spread over a couple of years.
Also, we've got the impact of what's going on in the United States. Now, I noticed the jobs numbers there. Well, we saw what we're now 14.7% unemployed in the US, 20 million laid off in April. The market actually was up almost 2% in the US after that news. But I mean, we must look at Wall Street. We must look at the impact that the US market will have on our economy too.
That's precisely right. The US share market led us on the way down, and of course, to some degree, it's leading on the way up as well. I mean, it does seem perverse, the reaction we saw on Friday, but we've seen that now for the last 5 or 6 weeks, that Wall Street has been able to rally despite bad news. And that is because Wall Street collapsed. Share markets collapsed going into March. They fell 35-odd%. So the markets had sort of led this downturn. And now when the economic news comes out, the markets have moved on to something else. I think Wall Street's sort of saying, yeah, we knew that unemployment was going to go up. We knew it was going to be horrendous. In fact, the 14.7% was a little bit less than expected. But the market is focusing on all the fiscal stimulus being pumped in, the monetary easing, and the prospects for reopening the US economy. So I think that's what the market's largely focused on. And that's why you got that somewhat perverse result.
Yeah, whatever it takes for the Fed. Well, look, Shane, Oliver, it's great to get your perspective. Thank you very much for joining us.
Thank you. My pleasure.